Ever looked at your money just sitting in a savings account, barely earning anything, and wondered, how can I get this cash to actually work for me?
Oh, definitely. It's a super common thought, isn't it?
It really is. You work hard for your money, so it makes sense that, your money should be working hard for you too.
Exactly.
Well, imagine your financial future as the ultimate road trip. And those investment options you hear about, they're not just jargon. They're the different rides you can take.
Ah, the rides. Oh,
Yeah, the rides to get you to your dream destination, whether that's a new home, a secure retirement, or maybe that epic world tour you've always envisioned.
I like that framing.
So today, we're embarking on a deep dive into the world of investment vehicles. We're pulling insights from A Guide to Investment Vehicles by Dollars and Cents, published back on July 13, 2025.
Got it.
Our mission, to help you understand these diverse financial vehicles, from the speedy and exciting to the steady and reliable, so you can confidently choose the right mix for your unique journey.
Makes sense.
But before we even start the engine, remember, knowing your financial goals, understanding your comfort with risk, and having a clear budget are your essential pre-trip checks.
That's such a great way to put it.
Right.
What's truly illuminating here is how these familiar analogies like the road trip really simplify what can feel like this vast, intimidating financial landscape.
Right. It feels less scary.
Totally. It's not about finding the best car out there, but about picking the perfect vehicle for your specific journey and, importantly, your destination. Ultimately, understanding these choices is, well, crucial for making informed decisions, moving beyond just, following the crowd or what your friend might be doing.
Exactly. It's all about personalizing the journey.
Yeah.
So if we're talking about exciting rides, we have to start with what many consider the flashiest option in the garage, stocks.
The sports car?
The sports car, yeah. Think of them as the sports car of investments. When you buy a stock, you're literally owning a tiny piece of a publicly traded company. It's a direct stake in its future. But what's the real appeal here? I mean, how do you actually win with a sports car, so to speak? How do you get those potential gains?
Good question.
Well, there are primarily two engines driving value here. First, there's capital appreciation.
Fancy term.
Yeah, it's just a fancy way of saying growth. This is like buying that sleek sports car for, say, $50,000. And a few years later, maybe it's worth $70,000 because the brand got more popular. Exactly.
Yeah.
You sell it, that difference is your profit. The other powerful engine is dividends. Many well-established companies will share a piece of their profits with shareholders through regular cash payments.
Like a loyalty bonus?
Precisely. It's like getting a consistent bonus just for being a loyal owner.
But just like any high-performance sports car, there are inherent risks to navigate, right?
And bumps in the road.
The primary one is market risk. This is the risk that, broader economic downturns or maybe sector-wide traffic jams could affect your stock's value, regardless of how well that individual company is actually doing.
So it's out of the company's control sometimes.
Yeah, pretty much. Then there's business risk. Even a great company can hit a rough patch, maybe a misstep, a new competitor, causing its stock to drop.
Like Blockbuster.
Oh, Blockbuster is the classic example. Failing to adapt to streaming, that's a vivid reminder of business risk. And for less popular, smaller companies, you might run into liquidity risk.
Meaning it's hard to sell.
Yeah, where it's tough to sell your shares quickly without impacting their price. A bit like trying to sell a rare niche antique car. It takes time and the right buyer.
Okay, that makes sense.
Given these dynamics, the natural question becomes, who is best suited to drive this kind of vehicle?
Right, who's this for?
Stocks are really for those looking for potentially significant long-term growth and, crucially, who are comfortable with the ups and downs that come with that potential.
So you need patience.
Absolutely. If you're saving for something far off like retirement, stocks give you the runway, the time to ride out that market volatility. The longer you're in the driver's seat, the more likely you are to navigate those bumps and still reach your destination.
Riding out the waves for the long game, yeah. Okay, so if stocks are the sports car, what about something that offers maybe a different kind of stability?
Good transition.
That brings us to bonds, which we're calling the dependable sedan.
I like it. Dependable.
Exactly. Instead of buying a piece of a company with a bond, you're essentially lending money to either a company or a government.
Like a loan.
Yeah, a loan. They, in turn, promise to pay you back with interest over a set period. It's a bit like being the bank for a reliable borrower.
Exactly. And when you look at the broader financial picture, bonds offer a very different flavor of stability compared to the, growth-oriented nature of
So
stocks.
how do you win with the sedan?
How you typically win with this dependable savan is through fixed income. You receive regular, predictable interest payments. It's that consistent paycheck we all appreciate.
Steady eddies.
Pretty much. And perhaps even more reassuring, you get your principal back. When the bond reaches its maturity date, the end of the loan term, you get your original investment amount returned to you. It's designed to be straightforward and reliable.
But even the most dependable sedan can hit potholes, though, right?
Always potholes somewhere.
With bonds, a key concern is interest rate risk. If new bonds are issued with higher interest rates, your existing bond, with its lower rate, might become less attractive, reducing its market value.
Like an older car model.
Exactly. Like when a newer car model comes out with better features, affecting the resale value of your current one. Then there's inflation risk. That fixed income we just talked about could buy less in the future if inflation really picks up speed.
Your buying power goes down.
Your steady paycheck, while consistent, might not go as far. You also have credit risk.
Which is basically the risk they don't pay you back.
Right, the risk the borrower might not be able to pay you back.
Hmm.
But this is something you can significantly mitigate by choosing bonds from reputable companies or governments with strong credit ratings.
Check the ratings, yeah.
And yes, some bonds might also have liquidity risk, meaning they're not traded as frequently, making them harder to sell quickly if you need the cash.
Like some niche bonds.
So for you, the driver, bonds are a fantastic option if you're looking for steady income, a lower risk profile, and importantly, a way to diversify your portfolio. They often move differently than stocks,
That's key.
which can provide a valuable balancing effect during market swings.
Definitely. So shifting gears a bit from these individual vehicles, what if you want instant diversification without having to pick and choose individual stocks or bonds?
The easy button.
Kind of. That leads us perfectly into mutual funds, which are like the tour bus.
Okay, the tour bus, lots of people involved.
Exactly. Here, many investors pool their money together into one large fund. This collective pot is then professionally managed.
Someone else drives the bus.
Someone else drives, yes. Managed to buy a diverse range of investments, stocks, bonds, sometimes even other things. You essentially own a small piece of this bus and all its varied contents.
So what are the wins here?
The benefits of riding this tour bus are clear. You benefit from capital gains as the underlying investments grow. You also receive your share of dividends and interest distributions that the fund earns.
Passive income, sort of.
In a way, yes. And of course, you can sell your shares in the fund for a profit if the overall value has increased. It's a comprehensive package designed for ease of use.
That professional management and diversification sound great, but even a tour bus can have its operational challenges, right? What should listeners be aware of with mutual funds?
That's a really great question to ask. Like
Right.
any investment, there's still market risk.
Can't avoid that entirely.
Nope. The fund's performance ultimately depends on how well its underlying holdings perform in the market. A big factor to consider are fees and expenses.
The costs.
Yes, mutual funds have operating costs, management fees, administrative costs that can eat into your returns over time. It's crucial to understand these.
Very the fine print.
You do. And a minor point on liquidity risk. Mutual funds are typically priced only once a day at the market close. So unlike individual stocks, you can't buy and sell them throughout the trading day.
Good to know. End of day pricing.
But despite those points, what's truly compelling here is the sheer accessibility this vehicle offers, especially for everyday investors. You get instant diversification across potentially hundreds of securities with just one purchase.
Wow, hundreds.
Plus the peace of mind of professional management. This is why mutual funds are such a common choice within retirement accounts like 401k. They form a practical cornerstone for many long-term financial plans.
Okay, speaking of professional management and diversification, let's look at something similar, but maybe with a bit more flexibility. Exchange-traded funds, or ETFs.
The ETF.
Think of them as the customizable van,
Customizable van. Okay,
Yeah.
more hands-on.
in a way. They're often described as mutual funds' cooler, more nimble cousin. Like mutual funds, they pool money to track a market index or a specific sector. But here's a key difference. ETF shares trade on stock exchanges throughout the day, just like individual stocks.
Intraday trading. That's big.
Exactly. The primary win with this customizable van is its ability to replicate market returns. If you want exposure to the S&P 500, for example, there's likely an ETF designed to mirror its performance.
So you get the market's return, basically.
Pretty much. You profit from the collective returns of all the assets held within the ETF. It's a very efficient way to get broad market exposure without picking individual companies.
While they offer incredible advantages, even the customizable van has a few points to consider, right?
For sure.
They'll still go up and down with the market. That's a fundamental risk you can't really escape if you're tracking an index.
Still market risk. Got it.
Also, because they mostly track an index passively, they have less active management flexibility. This means an active fund manager won't step in to try and navigate tough times by deviating from the index.
So no one's steering around the potholes necessarily.
Not usually, no. ETFs simply follow their programmed route, for better or worse.
Okay.
But here's where ETFs truly shine for many investors, especially newer ones. They're incredibly popular for their instant diversification, their transparency. You generally know exactly what they hold every day.
You can see inside the van.
Huh. Yes. And they're typically lower costs compared to actively managed mutual funds. That's a big draw.
Lower fees are always good.
Always. Their excellent liquidity, being tradable throughout the day, is another big plus. For new investors, they're often highly recommended because they offer a balanced, low-cost entry point into diversified investing.
Sounds like a solid starting point for many. Okay, so we've talked stocks, bonds, and these broad market funds. But what if you're interested in real estate without, the hassle of being a landlord?
The landlord life isn't for everyone.
Definitely not. That brings us to real estate investment trusts, or REITs. We're calling them your share of the property market.
REITs. Okay, like owning a tiny piece of a mall.
Exactly. Instead of buying an entire apartment building or a shopping mall, a REIT is a company that owns, operates, or finances income-producing real estate. You buy shares in that REIT, just like you would a stock.
So it trades like a stock, but it's backed by property.
You got it. How do you win with a REIT? Well, they are legally required to distribute most of their taxable income to shareholders annually.
Oh, that's interesting. Required distribution.
Yeah, which often translates to higher dividend yields compared to many other investments. Plus, you get the potential for capital appreciation. If the value of the properties the REIT owns increases, your shares also typically go up in value.
So income and growth potential. What are some of the property market's nuances to watch out for?
Good question.
Well, you're definitely exposed to real estate market fluctuations. Just like individual home prices, the values of commercial properties can go up and down, affecting your REITs.
Makes sense. Property cycles.
They also have interest rate sensitivity. Rising interest rates can impact property values and make borrowing more expensive for REITs, which can hurt profits.
Okay, so interest rates matter here too.
They do. And consider business dependency. If a REIT focuses heavily on a specific sector, like maybe office buildings or retail malls, and that sector faces a downturn.
Like online shopping hitting malls.
Exactly. Then the REIT's performance will likely suffer.
Gotcha.
However, connecting this to the bigger picture, REITs offer a really unique way to diversify your portfolio by easily adding real estate exposure.
Without buying a whole building.
Precisely. They can also act as a powerful hedge against inflation, as rental income and property values often rise with general price levels, offering a distinct advantage over, say, fixed income assets.
That's a great point about inflation.
Yeah. They're a fantastic choice for investors seeking regular dividend income and direct exposure to commercial real estate without the complexities of direct property ownership.
Okay, switching gears dramatically now. For those who absolutely prioritize safety and predictability, let's talk about certificates of deposit, or CDs.
The safe route.
The super safe route. We like to call them the armored car.
Perfect analogy.
A CD is essentially a special savings account where you agree to lock up your money for a set period, say 6 months or 5 years, in exchange for a fixed interest rate that's usually higher than a standard savings account. It's designed for maximum security.
You're right. It's all about peace of mind with CDs. How you win with this armored car is through fixed interest rates and a guaranteed return. You know precisely how much you'll earn.
No surprises.
And your principal is federally insured up to $250,000. It's predictability and security in one package.
But even an armored car has its trade-offs, right? It's not exactly speedy. What are the potential downsides for CDs?
To a point, what's the catch?
Well, the primary bump in the road for CDs is early withdrawal penalties. If you need your money before the agreed-upon term is up, you'll likely face a penalty, losing some of your interest.
So you got to be sure you don't need the cash.
Exactly. You also generally see lower returns compared to many other investment options, like stocks or even bonds, over the long term. Safety often comes with a trade-off in growth potential.
The safety premium costs you potential growth.
Right. And there's inflation erosion. If inflation significantly spikes, your fixed interest rate might not keep pace, meaning your money's purchasing power could diminish over time.
Can lose value in real terms.
Yeah. So for those who truly prioritize capital preservation above all else, CDs are ideal. They're perfect for short-term, critical goals like saving for a down payment or building out a rock-solid emergency fund.
Makes sense for those specific goals.
Okay, finally, we arrive at what might be the most crucial vehicles for long-term wealth building: retirement accounts, specifically 401ks and IRAs.
The long game focus.
Absolutely. And it's important to clarify something here. These aren't investment vehicles themselves, but rather special tax-advantaged containers for your investments.
Ah, the container, not the contents. Good distinction.
Exactly. Designed specifically for retirement savings. Think of them as the long-haul RVs, super efficient vehicles built to optimize your journey over decades.
RVs for the retirement road trip. Love it.
Let's look first at 401k, which are typically employer-sponsored plans. A massive benefit here is employer matching.
Free money.
Seriously, it's often described as free gas for your RV. Your employer might contribute extra cash to your account, often matching a percentage of what you contribute.
You absolutely have to get the match if it's offered.
It's non-negotiable, really. Some plans also allow you to take loans from your 401k without penalty in a genuine pinch, which can be a valuable safety net.
Good backup option.
However, a common limitation is often limited investment options. You're generally restricted to the mutual funds or ETFs offered within your employer's specific plan.
Right, you get what they offer.
Pretty much.
Then you have IRAs or individual retirement accounts. With an IRA, you typically gain more investment flexibility.
More choices in the RV park.
Exactly. You can choose from a much wider range of options, individual stocks, tons of mutual funds, ETFs, you name it.
So more control.
More control, yes. The trade-off is there's typically no employer match or loans directly from an IRA, unlike some 401ks.
Can't have everything.
And here's where things get really strategic with these RVs. Choosing your tax tunnel, traditional versus Roth.
Okay, tax strategy time.
With a traditional account, your contributions might be tax deductible now, meaning you pay less tax today, but you'll pay taxes when you withdraw the money in retirement.
Okay, later.
It's like deferring the tax toll until later in your journey. With a Roth account, you contribute money you've already paid taxes on.
Pay now.
But then qualified withdrawals in retirement are completely tax-free. It's like paying the toll up front for a smooth, tax-free ride down the road.
Tax-free growth and withdrawals sound amazing.
It can be incredibly powerful. This all leads to a crucial question. Why are these RVs, these retirement accounts, so indispensable for long-term planning?
Why are they so key?
They are absolutely crucial for building long-term wealth because they offer significant tax advantages that can really accelerate your growth over decades. And again, if your employer offers a 401k match, prioritize contributing enough to get that free money.
Don't leave it on the table.
It's an instant guaranteed return on your investment that you simply shouldn't ignore.
It's clear that just like no two road trips are exactly alike, your investment journey is truly unique, isn't it?
Completely unique to each person.
The best investment vehicles for you depend entirely on your individual goals, your comfort with risk, your timeline for needing the money, and your current financial situation. There's no single best ride for everyone.
One size fits none, really.
Exactly. In fact, the smartest strategy often involves using a combination of these vehicles to build a truly diversified and resilient portfolio.
Layering the approach.
Yeah, layering it. For example, you might start by contributing enough to your 401k to get that employer match that's non-negotiable free money.
Step one, always.
Then, maybe you open an IRA for broader investment choices beyond what your employer offers.
For that extra flexibility.
Right. And for money you might need sooner, perhaps a down payment in 5 years, you might invest in a regular brokerage account, maybe using ETFs for diversification, knowing that money isn't locked away for retirement.
Different pots for different purposes.
Exactly.
And if we truly connect this to the bigger picture, diversification isn't just about playing it safe. It's really about optimizing your entire financial journey.
Optimizing, I like that.
The layered approach allows you to leverage the unique strengths of each vehicle, get the growth potential of stocks and maybe real estate, the stability from bonds and CDs, and those incredible tax advantages from retirement accounts.
They need it all together.
Yeah, it helps you build a truly comprehensive financial plan that adapts adapts to your unique path and hopefully gets you to your financial destination with confidence.
We've just taken a deep dive into how you can get your money working harder for you rather than just, passively sitting by. Understanding these powerful vehicles truly empowers you to take control of your financial future.
Knowledge is power here.
It really is. So as you think about your next financial step, what insights from today's discussion resonate most with your own financial road trip? Where are you heading?
And thinking about all these options, it raises an important, maybe final question for you, the listener. Considering the diverse choices available, how might actively reviewing your financial goals and your risk comfort, maybe doing it annually, change the vehicles you choose for your ongoing journey?
Even if the destination stays the same.
Exactly. Even if your ultimate destination remains the same. Something to think about. Happy investing.